Welcome to Stocks to Watch, a platform to help you take care of your financial future. I am Munir Barazi, your business analyst and host, and joining me today is Euan Sinclair, the Senior Financial Engineer at Hull Tactical Asset Allocation, a Chicago-based investment manager founded by legendary trader Blair Hull. The firm specializes in quantitative, research-driven portfolio management with a simple mission to help investors navigate the ups and downs of the market using data, discipline, and innovation. Hello, Euan. It's good to have you with us today.
Hello, and thanks for having me.
Absolutely. So I have a lot to cover with you today, so let me just get right into it. You hold a PhD in theoretical physics and have more than 25 years of experience trading various products, including options, indices, commodities, you name it. So what insights, to start from physics really, what insights can we draw about risk, volatility, and probabilities from theoretical physics?
Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos.
Well, physics is a very big field, so it will obviously depend on exactly what you did. But I was thinking about this question, and I think I'm going to have to say none from my specific side of physics. It was very theoretical. And this was sort of in the day before everyone was using computers to do everything. So there was computing in my PhD, but not a great deal of it. It was mainly the old-fashioned pencil and paper type thing. And by far the most important mathematical concepts to know in the market are statistics and probability. And that's not really something that physicists address. I would say physicists, though, are very quantitative, obviously, but they also have I think the good ones anyway, I'm not saying I'm the good one, but I certainly studied with good ones. We have a very clear idea of what it is that's a model and what it is that is the reality that we're trying to model. And I think that's really important with the markets. It's very easy to sort of get yourself so buried in the mathematics, you forget that what you're doing is really just playing with a map. You know, for volatility, for example, it's very easy to start thinking, this is an exponentially weighted moving average, this is rough volatility, this is GARCH or whatever. But they're all models we lay on top of reality. The reality with volatility is that it's a measurement of how uncertain we are about the future. I mean, and that's much deeper than stocks wiggling around, or how you quantify stocks wiggling around. Because if the markets weren't uncertain, no one would ever buy an option because you'd know where the stock would expire. So it's that, particularly from quantum physics and chaos, which is what I did, it's very much tied up in those deep notions of uncertainty and what you never will know. So I think if you're just looking for the quantitative skills, I think engineers are probably better, but they make another big mistake in that engineers build stuff and engineers try to build models of the market to outpredict the market. And that's the wrong way round. There's two mistakes people can make when they approach the market. They can either watch a few YouTube videos and decide it's easy, or they can think, I'm going to build some massive model that tells me what's going on all the time. And engineers make that second mistake.
Exactly. I'm thinking that they might try to make it too deterministic. Going back to what you said, statistics offer many useful tools to help us understand volatility, such as, for example, standard deviation. You can measure volatility in the number of standard deviations you're willing to tolerate when you're trying to measure how many standard deviations you can handle. But I was also thinking about energy, because in the market let's assume there is buying energy and selling energy, or you can frame it in a different way. You can think about it in terms of potential energy or kinetic energy, depending on which side the market is moving on. So is there a way to kind of, without projecting too many pre-made assumptions, But is there a way to use those concepts when it comes to trading?
In terms of the exact analogy with energy, I don't know of one. I don't see that, because energy in physics is just a conserved integral. And I don't know of anything in the markets that are similar to that. I have seen some interesting stuff people have done with thermodynamics in defining a temperature of the market. But I think the thing with physics more is the overall approach to understanding the world rather than any particular concept from physics. I think it's more of a mindset and a scientific and quantitative approach.
Absolutely. And that's very interesting. And I want to go back to what you said earlier about options. You mentioned that we can find a lot of opportunities in this fundamental uncertainty that markets are characterized by, which opens, the door for a lot of potential. And options are an excellent tool for hedging against risk. In addition to being also a great tool to enhance overall portfolio performance. So, what strategies do you typically employ at Hull Asset Allocation with options to outperform the market?
Yeah, I mean, I think you've nailed the two completely different uses for options, right? They are the ultimate insurance tool. And they are a much better insurance tool than anything you can do by trading the stock, because they insure you against jumps, discontinuities in a way that a trading strategy won't. But also, I think that because people are prepared to pay for insurance, and rationally, like we're certainly not saying that if you buy insurance, you're stupid. I mean, I have my house insured, my cars are insured. So that's perfectly rational. But because there's a demand for that insurance, it's almost always overpriced. So that's the simplest example of how we use options to enhance returns, is we look for situations where other people, for whatever reason, are prepared to pay more than the pure statistical expected value. So if you're a finance guy, you'd say their utility function is different. And that's fine. It's a real thing. But we're looking for systematic flows like that distort the true value of the option. And this is happening a lot right now, not just on the people buying puts side, but there's a lot of ETFs now that systematically sell calls. Like every day, they'll just come in and sell calls. And that's had a significant effect on the value of those options. They are, well, not the value, but the price. They are now often trading below where they should. I mean, frankly, if anyone tells you what they're going to do in advance, you can take advantage of that. And if all they do is the same thing every day, well, to me, that's crazy, right? There's no business in the world that can sell something no matter what the price is. But they will sell these options no matter what the price is. So it gives us great opportunity for buying cheap options in that regard.
It's an interesting way to take advantage of this, and it's an informational advantage, really, the way you described it, because you know what they're going to do in advance, even by a few seconds ahead. You can actually take advantage of that, and I believe that's how high frequency trading works. Those algorithms take advantage of orders in the market, even by milliseconds, to make profit. And I also want to touch on another aspect when it comes to trading. People often draw parallels between gambling and trading. And personally, I find that there is a fine line between the two. And many great poker players are actually also very good investors or traders in the market. There are many principles from gambling which can be applied to improve trading and investing outcomes. So what tips or techniques can you suggest to help traders master their inner game and their return?
Yeah, I'm glad you said you see a very fine line between the two, because I see no line between the two. And I think if you look up the definition of gambling and investing, they're very similar. In both cases, you're putting money at risk in an uncertain environment, trying to make money. And I think the distinction people like to draw is gambling's got a kind of seedy reputation, and investing is kind of you're a prudent business person. But for me, I don't see that saying gambling's a bad thing. I know professional sports gamblers who do very well. Our founder was a professional blackjack player. He's in the Blackjack Hall of Fame. He was in one of those original teams that, back in the early 70s. And he parlayed his $500 blackjack investment into, hundreds of millions, billions of dollars. So we are very much founded on the ethos of gambling as a way of getting insight. And good gamblers understand they need to have a statistically valid edge, and then they need to manage risk in such a way that they stay in the game. And that was one of our founders' statements. He was on Bloomberg recently as his quote, have an edge and then stay in the game. And that's really all you've got to do. You're not going to make all your money through one lucky roll of the dice. You just come in, you grind it out every day, and over time, you'll do fine. And I find if I explain what I do to blackjack players or sports gamblers in particular, they really get it. And I know people, especially during COVID when there was no sports, I know people who made the transition from sports gambling into options trading very successfully.
I can definitely imagine. And I'm glad you also touched on that, because I believe that the behavioral skills and also the ability to understand statistics are important in both aspects, gambling and trading. You need to have discipline. You need to tolerate a degree of loss and carry on until the law of large numbers starts to play out in your favor. And that also is the same. It applies in trading and in financial markets. And you also need to have a sense for statistics or how the odds are stacked out for you or against you, which really confirms your point that there isn't any fine line, except when it comes to perception of gamblers and traders. And I believe timing is also a crucial aspect, especially in trading. I see that top performers often time their trades better than others. Yet some argue that timing the market or trying to time the market is really a futile effort, because it's very hard to pick a top or a bottom. What is your view on that? Do you agree, disagree, and why?
Well, our ETF is specifically claiming we're a market timing ETF. So we are doing that thing that in the 70s everyone said was impossible. And back then it probably was, to be honest, because transaction costs were a lot higher, the quality of data was lower, computing was much worse and much more expensive. So we are definitely timing the market, but I think the way we don't do entries and exits. We think that is trying to nail it to one particular point is too hard. But what we do is we increase or decrease our exposure to a given risk factor. And in this case, it would be the risk factor is the market. So we will either be, long 150% or only long 50%, depending on what our signals say. We found that to be a much more successful way of approaching the market than picking a bottom or picking a top, because you have to be so right with that. Whereas we just really have to be sort of right-ish, and over time, that's enough. So I know people from the outside, and I'm not saying you're from the outside, obviously, people from the outside often think, we're sitting there and we go, now. But we don't claim that level of knowledge at all. I think it's more that we're comfortable in what we know, and we're comfortable with how weak that individual signal is. But over time, it will add up. We're not claiming we have some magic indicator. Our models have got, I think right now, 40 different inputs into them. And we call them micro alphas, because on their own, they don't add enough to beat the market. But when you add them all up, then you can beat transaction costs. And then if you're realistic, I think we're aiming to make about 3-4% alpha, which I think is doable. It has been doable. But if you think you can double your money every year, that's where people are going to get into trouble.
Absolutely. And so in a way, you manage exposure based
Yes.
on your view of how the distribution of the potential outcomes is really, and you try to kind of minimize or maximize the reward when you're right and minimize the penalty when you're not right, which is really wise and probably the only way to kind of make a decent return on investment. And the return you mentioned is impressive, when benchmarked against other ETFs. Would you like to comment on that? How does your ETF perform against perhaps some of your peers?
Well, I don't want to get involved in anything that compliance is going to yell at me about, and I can't remember the exact numbers. But last I looked, we outperformed on the 1 year, 3 year, and 5 year horizon, both in terms of alpha and Sharpe. And we're very much interested in, like, as you said, having better upside capture and downside capture. So when the market goes down, we want to go down less. And we have done. It was phenomenally interesting, right?
So, Euan, my next question is about AI. It's now the topic of the day. Markets are constantly evolving, and now AI has entered the picture, particularly in quantitative strategies. In what ways can AI contribute to more effective investing?
Well, I think just at a very high level, right? Anyone who thinks AI is not going to impact their job, no matter what it is completely wrong. If you just look at the history of technology, everything that can be automated at every stage has been. And that's what AI is going to do. And right now, we use it a lot for speeding up our coding process. Like, it will generate simple stuff very quickly. It also can write things like press releases, and it can go through and edit our prospectus and all these kind of the sort of things you'd throw at a junior intern. It's spectacular at, and it's got so much better over the last year. Right now, you have to remember these are called LLMs, large language models, and are very good at that kind of stuff. They can't do mathematics, and they're not designed to do mathematics. So we're not at the point yet where we can really have them come up with algorithms. It will help us code to put those algorithms into production. But right now, it's not there. Having said that, it could well be there in 6 months, because anyone who's been using this stuff knows how quickly it's been progressing. Right now, it's kind of a very, very smart Google, but the rate at which it's getting smarter is amazing. Everyone always says, I want to hire people smarter than myself. Well, this is your chance.
Yes. Yes. Well, things are evolving really fast, and I wouldn't be too surprised to see a very powerful AI coming sooner than expected. And I believe what's interesting about AI, not necessarily LLMs, but the ability of computers today to process huge amounts of data and recognize patterns within that data and get something that resembles a model, of course, with the help of perhaps a theoretical physicist like yourself, or a mathematician, or someone who can calibrate those models. I think with that, the potential is so huge in the future to kind of refine several investment strategies. I see that you would like maybe to comment on this.
No, I was sort of nodding away in agreement. We've been using what 10 years ago would have been called big data, but now is just called data. And we also use machine learning, and machine learning techniques have been around for a long time. So most of them are essentially adaptive nonlinear regression. I mean, that's all neural nets. We've been using those kind of things, and they are at the heart of our model. But I think saying machine learning is like a steam engine.
Mm.
AI is like, Google. We're looking at very different things, and I think they get clumped in together, but they're not in any way the same thing. They're both very useful, but they have their own domains of use.
Absolutely. And there are many viewers watching us today who are keen to also learn from you and your experience. So, what advice would you offer to both experienced investors and beginners alike?
I think you hit on it earlier when you were talking about gambling and particularly poker players. Um, I don't think poker players, in terms of the edge, I don't think that's as translatable to the market, but the big thing they know is variance. Like they know how easy it is to be right for a long time and still be losing money. Because there's a difference. People have to realize a losing trade doesn't mean it's a bad trade, and a winning trade doesn't mean it's a good trade. If if the stats are on your side, that's just what you have to go to, and you have to work through that variance. And you also nailed on this very astutely, I thought. Statistics isn't just about measuring numbers. Understanding variance isn't just about pulling numbers out of a spreadsheet. It's understanding what it feels like to go through that. And that's a very different thing. So, I think no one said this was going to be easy. Well, actually, a lot of people say it's easy, right? But those people have YouTube shows and they're not making money themselves. They're driving around in, rented supercars with sunglasses on. Um, this isn't easy, but it can be done.
Mm.
So as long as you remember that trying to beat the market, it's a really hard thing to do. And if you do it at all, well, you should be incredibly proud. But don't set yourself unrealistic targets. And remember that you're playing a statistical long-term game.
Absolutely. A statistical game, and also, I think, a psychological game of sorts, or a mind game of sorts, because I believe that the human brain isn't necessarily optimized for dealing with a random instrument such as the markets, or the way price action behaves. I think human brains thrive on certainty, and the fundamental uncertainty you see in the markets is uncomfortable, at least for the human brain, and that could lead the trader to making suboptimal decisions. Let's just
Yeah.
call them that way. So it's really wonderful, all the things you're doing, and I'm really impressed that you're relying. Your edge is the way I see it is mathematical, uh, and relies on the long term performance, not just on nailing a single trade. The way it goes. My last question: how can potential investors or clients find you?
Okay, if you go to our website, hulltactical.com, you'll find contact information there. And please, if you have questions, get in contact with us. We're a colossal bunch of nerds here. We love talking about this stuff all the time. We'll tell you a lot of what's in our models. Like in our blog, we tell you a lot of stuff because what we're doing isn't necessarily a secret. It's just a lot of small things layered on top of each other. So please get in contact with us. I'd love to answer any questions anyone has.
Wonderful. And we will leave the contact information also in the description box section, so viewers can find that very easily. Euan Sinclair, the Senior Financial Engineer at Hull Tactical Asset Allocation, thank you so much for being here today and sharing those great insights. I really appreciated it and enjoyed our conversation. And I look forward to seeing you here again very soon.
Oh, I'd love to come back. I enjoyed it as well. Thanks for having me.
Thank you.